So yeah, just want to introduce Travis. So give him a big round of applause.
Thanks guys, thanks for coming, really appreciate you all coming. Thank you also to Brendo and Maddie for this opportunity to go through this stuff with you, really appreciate that. Cool, so there's heaps to get through, so I'm just going to get stuck right into it. I've got one of these as well, so I'm just going to pretty much, I've typed all this up, so sorry, it looks like a big 20-page document, but we'll get through it as soon as we can. Okay, so things we're going to cover in this session is what is a share, what is a dividend, how do I profit from owning shares, realised and unrealised gains and losses, how do I get started in investing, why do I need a broker, what is a portfolio, what is the ASX 200 and why is it important, what are market sectors and why is it important to know, what is a diversified portfolio, understanding the jargon and the market terminology, how to value a company's worth and share price, how to read and analyse charts, what makes a share price go up and down, keys to picking a good stock to buy, what to look for before investing in a company, understanding risks associated with investing, setting entry and exit points, how to safeguard yourself against a market crash, how many shares should I own, how to structure a portfolio, key mistakes most rookie investors make, that's a big one, knowing when to buy and sell, using watch list and paper trading. Cool. So, I'll try and run through this pretty quickly. If you do have any questions, we'll probably have a question and answer session at the end, but if there's something you don't understand, just put your hand up and we'll try and go through it. Okay, so what is a share? A share, simply put, is a share. Sorry, a share is a part ownership in a business. You are essentially investing money up front in a company so that you can share in the company's profits. The more shares you have, the more you'll receive back in profits. Everyone cool with that? Straightforward? So what is a dividend? A dividend can best describe as a portion of a company's profit that is distributed to its shareholders. Dividends are generally paid every 6 months. Some companies pay every 12 months. There are even some that pay every 3 months. Each company determines the dividend amount it pays out according to its expected versus actual profit made for the period of the 3 to 6 or 12 months. Not all companies pay dividends. So that is something to consider if you're looking at a particular company. Does it pay a dividend? Dividends are something to keep in mind when assessing the value of the company and its potential returns. We'll go over that later. All dividends paid are taxable. So that means that meaning you need to pay tax on any money that you receive by way of a dividend. Some companies actually pay the tax for you before they distribute to shareholders. This is known as franking credits. If a company's dividend is 100% franked, it means that they're paying 100% of the tax before they give it to you. So it's like free money, which is good. Some companies' dividend is only 70% franked or 30%. Some is 0%. So that means that the company is either paying 70% of the tax, 30% or 0% of the tax for you. These are all things to consider before making an investment. And again, we'll go over this stuff later. So how can I profit from owning shares? There are 2 ways that you can profit as a shareholder. The first one is by capital gain, which just means the share price going up. And the second is by dividend payments. Everyone clear so far? All good? Cool.
Yep.
So realised versus unrealised gains or losses. There are 2 types of capital gains. There's a realised and unrealised. You only pay tax on your realised gains, not your unrealised gains. So what's the difference? You might have bought a stock for $1 per share and it's now worth $5. That's a pretty hefty profit. However, this is called an unrealised gain. Until you actually sell that stock, you haven't actually made anything. All you have is the ability to make money if you want to. You can keep that stock for 10 years if you wish. It will always remain an unrealised gain until you decide you want to sell it and take your profits. This is when it turns from an unrealised gain into a realised gain, which basically means when you physically have the money in your account. It then comes a realised gain and then you pay tax on it. Everyone clear so far? Excellent, good. So how do I get started in investing? So to get started, you need only a couple of things. You need some cash, obviously. You can start with just $500. The minimum spend is $500, so it's not a lot. You need a broker. Online brokers are the most common. You need a portfolio and a stomach of steel and a positive attitude towards investing. Why do I need a broker? A broker is the middleman that does all the paperwork and lodgement of documents. He also liaises on acts on behalf of both the buyer and the seller. Here's an example. Let's say I want to buy 100 shares in BHP Billiton, and Dave wants to sell 100 shares of BHP Billiton. BHP sells for about $22.50 per share at the moment. That means that the investment will cost me $2,250, which is essentially $22.50 times 100 shares.
Yeah.
Clear? Cool. So the broker will go to Dave and say, hey, I've got a buyer for your shares. The market price for this is $22.50, but I've got a buyer who's willing to pay $22 per share, and they'll take all 100 shares off you. Do you want to sell for $22 a share? Now let's assume Dave bought these 100 shares in January 2016 for $14, because in January 2016 that's how much they were worth. They were $14. That means his initial investment was $1,400, which is $14 times 100 shares. It's pretty straightforward, right?
Yeah.
If he accepts the deal for $22, he will get $2,200 into his account from the buyer, and has made a nice little profit of $800 in 18 months. Dave can decide that he wants to sell for $22.50 and not give the extra discount, in which case the broker will then go to the next seller on the list for that stock and ask the same question until he gets a seller to agree. The same example can be reversed. Let's assume Dave has 100 shares and he wants to sell because he feels like, well, the price is going to go down. He's paid $1,400 for his shares, and he wants to sell for the current market of $22.50. The broker will go to potential buyers and find out if anyone wants 100 shares at $22.50. If you think about this process the same as a real estate agent selling a house, you'll understand the process a bit better. The buyer always wants a discount, right? And sellers always want a little bit more, sometimes more than it's worth. So this is why you need a broker. So fortunately, in this day and age, everything is digital. Now there are digital brokers. They do all this behind the scenes in a blink of an eye, quite literally. What's even better is there are phone apps that do it instantly. In a matter of seconds, you can actually buy, sell a stock many times over and make or lose money in the process. For this convenience, of course, there is a fee, because in this world, nothing is free, right? In my opinion, the easiest broker to use is Commonwealth Bank's CommSec. Everything happens easily and instantly, and there's a fee of $19.95 per trade. This means if you want to buy a stock and you have a minimum share price of $500, there's a $19.95 fee on top of that. Just think of it like postage and handling fee sort of thing. You'll get your head around it. Conversely, if you want to sell a stock, there's also a $19.95 fee. So in the previous example, Dave sells his BHPs shares for $22 times 100. That would give him $2,200, but less the $19.95 fee that he's had to pay to sell the stock. Which the broker takes as like a finder's fee for finding the buyer, basically. In order for David to purchase the stock, he would have to have paid $19.95 at the original price. So his $1,400 that he paid, there was plus the $19.95. So let's sum this trade up and see what the overall profit was. Dave purchased 100 shares in BHP on the 1st of January for $14. His total investment was $1,400 plus the $19.95 that he paid to buy the stock. He then decides to sell, as he has found another stock he likes or needs to get a car serviced or whatever it is. So we now are in July and BHP shares are worth $22.50. The broker was able to find Dave a buyer for $22. He decided to accept the $22 and sell all 100 shares. Dave must also pay $19.95 fee to the broker. So he's left with $2,180.05, which is the $2,200 minus the $19.95. And he bought the shares for $1,419.95, and his total profit was $760.10. Make sense to everyone?
Yeah.
Cool. So that's just a real life example how you can buy, share, and profit. But yeah, there are fees and charges associated with that. Just a side note, just as the 1st of July, Commonwealth Bank have actually changed their fee structure. So if any purchase under 10,000, it's only a $10 fee now, which is great, instead of $19.95, so it's good. So what is a portfolio? A portfolio is just a list of companies that you have invested in. You might have one company or several companies in your portfolio. What is the ASX 200? The ASX 200, ASX stands for the Australian Stock Exchange. It's our stock exchange that we deal with here in Australia. There are many stock exchanges. There's the NASDAQ in America. There's the Dow Jones. There's heaps of them, but generally, well, the one that we deal with in Australia is called the ASX. And the ASX 200 is a list of the top 200 companies in Australia. There's also an ASX 100, an ASX 50, and ASX 20, which are basically the same thing. So what are market sectors and why are they important? One of the many keys to being a successful investor is minimizing your risk. Every shareholder must understand the risks associated with investing. How do you minimize your risk? Well, by understanding the market sectors and the importance of being invested in as many sectors as you can to help minimize your losses, because you will have losses. Warren Buffett is the world's greatest investor. He has just 2 golden rules. Rule number 1, don't lose money. Rule number 2, see rule number 1. A good way to protect yourself against losses is to be diversified across as many sectors as you can. What are the sectors? So in no particular order, these are market sectors you must be across. Financials, healthcare, utilities, consumer staples, consumer discretionaries, telecommunications, technology, energy, industrials, and materials. There are many more, but these are the fundamental market sectors that shape the market and will ultimately have a positive or negative effect on your shares depending on which sector you choose to invest in. Let's look at an example of companies you might have heard of or indeed know well in each of these sectors. Financials, the banks. So Commonwealth Bank, NAB, ANZ, Westpac, Bank of Queensland, all of those banks are in the financial sector. Healthcare, there's a company called Blackmores who make your vitamins and that sort of stuff. Utilities is AGL, gas and electricities. You would have heard of those companies.
Origin.
So, yeah, that's right. So the consumer market sector is divided into 2 different types. So there's the consumer staples, which is just basically the stuff that you can't live without. So your Coles, your Safeway, stuff that you use all the time. And then there's the discretionary side of consumer, which is the stuff that it's nice to have, but you don't really need it, which is your JB Hi-Fi, your Harvey Norman, that sort of thing. So telecommunications, Telstra is a pretty obvious one. Technology stocks like MYOB. Energy stocks is pretty much to do with oil and that sort of stuff, which would be ExxonMobil. Industrials, think of CityLink. They use and run all of the roads here in Australia, but they also have, which I didn't know, Transurban is the company that runs CityLink. They actually have roads in other countries as well.
Yeah. Right in America.
Which is owned as well.
Worldwide.
It's cool, yeah. And materials is basically any of the metals, gold, iron ore, that sort of stuff. So that's basically the 10 sectors. Like I said, there are more, but these are the main ones that have the biggest impact on the market. If one of them goes down, you'll know about it.
There's no manufacturing.
Hey?
No manufacturing or industrial.
Yeah, I guess, like I said, there's probably more, but these are the ones that I've sort of listed. So why do I need a diversified portfolio, and what does that even mean? A diversified portfolio means that you have shares in more than one industry or sector. If the Commonwealth Bank is down on Monday, you can bet your bottom dollar that NAB, Westpac and ANZ will be down as well. Sometimes for no apparent reason. When sellers see weakness in the financial sector, often all companies in that sector, or majority of companies in that sector, are down as a result. If your portfolio is full of financial companies, and they all go down, guess what? Every stock in your portfolio will be down for that day. When a seller sells his stock, or his position, which is sometimes known as, in the sector, often they go looking in a different sector for a bargain. hence raising the share price of other stocks in other sectors. If you aim to have one investment in each of the 10 sectors, you'll have the best chance of minimizing your losses, and conversely, capitalizing on your gains as well. Okay, so now we have a brief understanding of what a portfolio should look like and what types of shares we should be looking at. These are the most common questions when buying shares. Which shares should I buy? How do I know what's a good stock? What should I look for when evaluating a company? How do I know if a share price is cheap or expensive? These are very hard questions to answer. The truth is there's no formula. There is only data that can be analysed to give you a clearer picture of how a company is performing and if it's worth an investment at current prices. So understanding the jargon and the market terminology. Market jargon such as these listed below are actually extremely important when it comes to being able to evaluate a company and its share price. Let's go through a few ways we can evaluate a share price. A share's value using these jargon terms. EPS, P over E ratio, chart analysis, 50 to 200 day SMA moving averages, RSI indicator levels, profit loss statement, market guidance and dividends. Let's go through these one by one. So EPS. EPS stands for earnings per share. This is one way of determining the value of a stock. What does it mean? So earnings per share is basically the total income or the profit. You divide that by the total outstanding shares. So total outstanding shares means total shares available for purchase. So when a company lists, they might list their share price at, let's say, $1, and they'll put 1 million shares out for purchase. So there isn't an infinite number of shares that you can purchase. There's only a set limit, and therefore it gives it it's a way of being able to measure what is available and what price. Right, so this means if a company has a net income of $1 million, and they've released 1 million shares to the market to be purchased, their EPS would be $1 per share. Make sense? Because there's only 1 million shares,
yep.
And they made $1 million in revenue, in profit. So their EPS would be $1. If they had a net income of 10 million and they had 1 million shares available for purchase, their EPS would be $10. This would mean that the company made $10 of profit for each share that's available. It's just a way of measuring what the share price is worth and what each dollar is contributing to its share price. It doesn't mean that each share price is only worth $10. It just means that for each share that's available, it's generating $10 worth of profit. Does that make sense? Did I explain that right? Anyone confused by that? Okay, cool. So, a higher EPS is generally better. However, it depends on how much each stock costs. EPS does not take into consideration how much the stock costs. Here's an example. A stock could have an EPS of $100, but if it costs $1,000 to buy, then that's only a 10% return. If another stock has an EPS of $1, but it only costs $2 to buy, then that's 100% return. So the $1 EPS would actually be better than buying the $100 stock. Make sense?
Yep.
Cool. So EPS means that every share earns a certain amount of dollars in profit. Cool. All right. So P to E ratio. Now this is another one that's really important, and this one actually works in tandem with EPS, earnings per share, because without the PE ratio, you probably won't get an accurate. And again, there's no formula. Okay, these are just things to actually help you look at a stock and go, okay, its EPS is this, its PE to this. Is this a good investment or not? All right, it's just to give you an idea. So, a P to E ratio stands for price to earnings ratio. This is another common way of evaluating a company's share price. So the PE ratio or price to earnings ratio is the share price divided by the EPS. So we just figured out what the EPS was in the step above. So now we want to see what the price to earnings ratio is. Basically, for each share that you have, how much is it making? Yeah. So, right. So here's an example, right? So company A's share price is $100 and its EPS or its earnings per share was $10, then its price to earnings ratio is 10. Make sense? Okay. This means that the stock is selling for 10 times what its earning per share is. Does that make sense?
Yeah.
It's selling for 10 times what it's worth, basically.
Yeah.
Okay. Generally, a lower price to earnings ratio is better because it means it's cheaper to buy the stock. And generally, a higher price to earnings ratio isn't good because it means investors are paying more for the share than what its earnings actually are. Looking for companies that have a price to earnings ratio of lower than 15 is a good thing. But again, you have to compare apples with apples. So I would only use this when you're comparing two stocks in the same sector. Because if you're comparing something in a different sector, they have different things that influence their price up and down, and you're then not comparing apples with apples. So if you're looking in the financials and you want to know whether the NAB or the ANZ is a better buy, then use this, and it'll give you the earnings per share and the price to earnings ratio. If you want to know whether BHP or NAB is a better buy, this is probably not going to help you as much, and it's still good to look at, but you're not comparing two shares in the same sector, so it's not going to be as accurate. Make sense? Okay, cool. So, a lower price to earnings ratio means it's cheap, but generally means its revenue or profits haven't grown since the previous year. So cheap doesn't necessarily mean good either. Right? And a higher price to earnings ratio, which we said was probably not good, it means that it's more expensive to buy, but generally means its revenues and profits are higher every year. So investors pay a premium for it now in the hope that 3 to 5 years' time, it's actually worth a lot more.
Yeah.
So the investors are expecting that it's going to pay dividends for them. Not dividends in the word dividends, but it's going to be beneficial for them 3 to 5 years from now. If they pay for more for it now. So if it's worth say $3 and they're willing to pay $4 for it, hopefully in 3 to 5 years' time might be worth $7 or $8 because of its performance so far has been going up and up and up and up and up, as opposed to a company which is just going flatline, this sort of thing. It might be cheap, but there's a reason why it's cheap. It's because the growth is not there. It's steady, but it's not growing. So cheap doesn't necessarily mean bad. It doesn't necessarily mean good. And expensive doesn't necessarily mean bad either. It can be a good thing.
Cheap means more stable.
Yes. And we'll get to that in a sec. What
the risk.
And what sort of investor are you? And we'll get to that in a sec. It'll make more sense in a sec. Okay, so chart now. Does anyone have any questions on that previous thing?
Well, it's basically the potential future earnings.
Correct. Yeah.
Okay.
It's potential. And all of this is just potential. The whole thing is when you're investing in something, you're punting on the potential of a company skyrocketing or flatlining. So people pay more for the product for a company they think they're on a good wicket and they're going to increase in value, and they'll conversely pay less for something that they think in 12 months' time it's going to be in the same place, so it may not be worth the investing. But there are other features and benefits of flatline companies as well, which we'll get to in a second. Alright, so chart analysis, over the page. Before making an investment in a company, a good idea would be to look at its chart or its history over the last week, month, quarter, year, or even decade if you want to. This information is freely available on Yahoo Finance. You will be able to get a visual representation as to how the stock has performed over a period of time. When reading a chart of a share's performance, we are looking for a buying or a selling signal by the use of data analytics. Here are a few things to look for when reading a chart. Now there's heaps of charts out there. These two are my favorites. I think you can get a lot of good signals from these two charts. So the first chart is the 50/200 day SMA, which is a simple moving average. So basically that means there's a 50-day and a 200-day moving average, This is a very handy little tool accessible on any chart in Yahoo Finance, and it gives you two lines. The first line is the 50-day. So the 50-day average movement of the stock, which is its performance over the last 50 days, is called the moving average. It keeps refreshing every day. So at day 51, it discards day 1. At day 52, it discards day 1 and 2. So it's always a block of 50 moving this way, right? Where am I? Yep. And so it's always the current day and the previous 49 days beforehand. The second line on the chart is the 200-day moving average. This is the same as the 50-day in the way that it works, however, it is measuring the last 200 days of performance. The importance of these two lines will give you a good buying and selling signal, historically and according to data. There is no such thing as a formula, remember, nothing is for sure. Signals are a good way of confirming what you already think about a stock. It is said that if the 50-day, now I'm just reading through this now, on the next page there's a chart and we'll go through the chart and show you what it actually looks like. So it is said that if the 50-day moving average line crosses the 200-day moving average line from underneath, which meaning, I'll draw this, but you'll see it on the chart. So we use, so red is 200-day, and green is 50-day. Alright? So if I have a stock chart that looks like that, that's my 200-day moving average. So, meaning, okay. Let's do this. So, this is, let's say, for instance, 1, 2, 3. It will never look like this, but just to give you a visual of what it is. So this is dollars. So $1, $2, $3, $4, $5. And this is, let's say, June, July. So this is date, okay? September, October. Okay? So this is basically a moving average of each day, and then obviously within here you have day 1, 2, 3, 4, 5, 6, the whole days of every month. So it's moving like that for every day, how the stock has actually performed. So that's the 200 days. So just assume that there's 200 days between here and here.
Yep.
This one is the 50-day. So the 50-day only takes in, obviously, like I said, only takes into consideration the current day and the 49 days before. So we might have a 50-day, goes like this. Like that. So that could be the performance of the 50 days. This is the performance of the 200 days. So, going back to this. So it is said that if the 50-day moving average line crosses the 200-day line from underneath, which is this, so that's the 50 days, crossing the line from underneath, not on top of the line. I need another. This is called, that cross just there, that's called golden cross. Because when it's crossed that line, what happened to the share price? It went nuts. When it crosses that line. When it crosses this line here, it's going from great. As soon as it crosses that line, it dips. So that is called death cross. You'll see this for obvious reasons. As soon as it crosses that line, it dives. Alright? So you might see, you might see something like this, for example, and that, where it runs parallel. So when it doesn't cross, that is a holding pattern. So you would basically hold your stock, so not buy or sell, if you see parallel lines. As soon as you see a cross, if it's a death cross, time to sell because the stock is going to go down. Only according to data, okay? This could be wrong, It's just historically what happens with a stock. When it crosses that line, it dips. When it comes up and hits that line, it shoots up. So those are buying and selling signals. Yeah. Does that make sense to everyone? Okay, cool. There's another, on the next page, there is an example of that. Okay. So conversely, if the 50-day moving average line crosses the 200-day moving average line above, heading in a downward trend, which is this, yeah, we've covered that already. Okay, so we'll keep that. We're going to go to the next chart. So the next chart is an RSI level indicator. Another good way of predicting the stock's future performance is looking at the RSI level indicator. So RSI stands for Relative Strength Index. This is a visual indicator as to how much stock has been bought or sold. Generally speaking, if a stock has been sold down below its fair market value, which is also available on charts, the chances are it will show on the RSI indicator as oversold. Meaning the sellers have overreacted and sold out of fear of the price dropping lower, or indeed sometimes sellers are like sheep. If they see people selling, they sell as well. Conversely, if the RSI indicator will also tell if the stock has been overbought. Again, buyers are like sheep. They see someone buying, they buy as well. Price goes up.
Herd mentality.
Yeah, absolutely right.
That's right.
When the RSI indicator shows a stock in overbought territory, people then sell and the price falls. So, across the page, profit and loss statement. So this is our third thing that you should look at. This is another great way of valuing a company. Look at their profit and loss statements. They are also readily available online or with your broker. They will tell you how much profit the company made last year, and the year before that, and the year before that. It's not uncommon for companies to make a loss. Sometimes millions of dollars in the red. More often than not, there is a good reason for this, which is also on their profit and loss statement. Companies often make big acquisitions and buyouts of competitors to make them stronger and more profitable. So whilst they might have made a loss this year, the chances are that they will have a strong upcoming year. Another thing to keep in mind is a company's debt position. Most companies operate in debt, or at least have a debt facility or loan. Some companies have massive income, but even bigger debts. Some companies have a much lower revenue and income, but have next to no debt. Debt isn't always a bad thing. It's how the company addresses its debt and how it makes repayments to its creditors. So, when you're evaluating a company and looking at their profit and loss, there are two acronyms that you need to look at. So the first one is, and Bruno will know all about this. First one is EBITDA. The second one is NPAT. So all that means is earnings before interest, tax, depreciation, and amortization. Oh, we did that right. So more amortization. Right? And the second one is NPAT, which is net profit after tax. They're the two numbers that you'll see on a profit and loss statement. So EBITDA basically is earnings before interest, tax, depreciation, and amortization. So they'll give you, basically that's their raw figures that they've achieved for the year. But the NPAT is basically their bottom line, which is the net profit after tax. Because you might have a massive EBITDA, but then you've got, it's before amortizations and before depreciation. They might have bought out a company and paid millions of dollars for it, which is going to affect their NPAT, which is not reflected in the EBITDA. So you look at the EBITDA and go, wow, they made $10 million in profit for this month, for this year, but the NPAT shows that they made a loss of $100,000. doesn't make a lot of sense. It's because of this. It's earnings before interest, so they include interest, tax, depreciation, and amortization, which is basically buyouts and acquisitions.
Yeah. The right of goodwill, for example, is a typical example where they buy a company and they pay goodwill and they write it off.
Yeah, exactly. So it's your net profit after tax that you're looking at. So there are two numbers that you'll see on a profit and loss statement. Very important. Oops. Okay, and so quickly I'll go through the RSI, which we looked at on the previous page. So RSI, relative strength index, and you'll see it on this example as well. Try and draw this as best as I can. How are we going for time? 22. Okay. Okay. Alright, so you might see a share price do this. That sort of thing, right? So, the RSI indicator will show, so 50 is between 75 and 25 is where shares generally hang out. So if 50% is even Stevens, growth would be, there's a bit of growth, the shares went up, shares dropped a little bit under. So 50%, let's say, is its fair market value, what the market values a share at. It's chugging along nicely. It goes into above 75%. They say is. Let's see. Great. So let's see if I can get this right. Okay. So if it drops below 25, it's known as being oversold, which generally means that people have overreacted to a market guidance or something. And you see, as soon as it drops below the 25, there's an immediate pickup because people look at that and go, "Oh wow, that's cheaper than it should be. I'm going to buy." Conversely, when it crosses over the 75, that's into overbought territory. So basically, people have paid too much for this, and they look at it and go, "Oh, it's not worth that much. I'm going to sell because it's going to go down," and that's exactly what happens. It goes down below. So an RSI indicator, and you'll see it on that. Are we still on that page with the chart on it? Just go back one page. You'll see in the yellow underneath. You'll see, let's say at about December 15, see how it crosses this up to the 75 line. Immediately it drops to around the 50% mark, and then every time it touches that 75, which is the overbought territory, it comes back down. And then you'll see at December 16, the big drop, it goes along that line, and then there's an immediate underneath, say around January somewhere, and then there's an immediate uptake again. And that's how you read the RSI chart, and whether you look at whether a stock is actually oversold, overbought. It's just another way of looking and getting a read as to how your product's going, your company's going. All right, quickly over the page. Try and get through this as soon as possible. Market guidance. Now, market guidance is possibly the most important thing to consider when making an investment. Again, this information will be available to you through the broker or online or through the company's investor page on their website. Market guidance is where the company typically twice a year update the market with its future outlook and what it expects to achieve in the coming year. There are typically two very important areas of guidance that you need to watch for: earnings forecast and performance tracking towards earnings forecast. So at the start of each financial year, every company must put forward to the ASX its annual earnings forecast. So basically how much revenue and profit they intend to make for the coming year on whatever data the company might have. So new clients or other clients in their pipeline, new product launches, previous year's earnings, and they add a little bit of growth on there as well. And buyers and sellers will buy and sell based on this info. So they effectively have what they call an inverted commas priced in. They priced in the promise that was made to them by the company. So basically, if a share is worth $2 and the company says we're going to make $1 million of profit this year, then they price that in by saying, okay, we're going to value the shares now at $3, let's say. Share price goes up to $3 and it's steady at $3, which means that the market expect that they're going to deliver on what they said they're going to deliver. They're going to make their $1 million of profit like they said they would. Okay? Right. And every quarter, a company has to is required to give an update on to the market meaning you as a shareholder, as to how they are tracking towards their earnings forecast they made 3 months ago, 6 months, and 9 months ago. A market update might go a little bit like this. At the start of this year, we are going to make $1 million in profit. After 3 months, so that's what they say at, say, July 1. And then 3 months on, they release an announcement to the market that they've only made 100,000. Guess what's going to happen to the share price? It's going to tumble. On the other hand, if after 3 months they've already made $500,000, guess what? Share price goes through the roof. Why? Because they've performed better than the market's expectation, so the share price goes nuts. The single biggest mover of a company's share price has to do with the market's expectations. If they release a statement saying that things are not so good as we hoped, the share price will die. If they release a statement saying that things are going better than expected, the share price will rise. Everyone cool with that? Yeah. Okay. So dividends. We talked briefly about the power of dividends and what dividends mean for you as an investor and how you can profit from owning shares that pay dividends. Here are a few things to think about when you decide on a stock that pay dividends. Do they pay a dividend? Because obviously, like we said before, not every company pays a dividend. Is it fully franked? So is it tax-free money? What is the payout ratio? This can range from 2% unfranked all the way up to 12% fully franked or tax-free. How often do they pay dividends? Some pay annually, some biannually, some quarterly. Dividend stability. Dividends are a reward from a company as a thank you for partnering with them and enabling them to achieve their goals and targets with your capital investment. Not all dividends are guaranteed. If a company says that they'll pay a dividend and then have a bad year financially, often the first measure they cut in their cost cutting is to waive the dividend payments that they promised that they would make. Most brokers will give each company a ranking out of 100 based on previous dividend payouts. So a company like Telstra, who are managed dividend payouts, they're basically 100%. They're guaranteed that whatever happens to their company, they will pay out the dividend. Because that's why you buy Telstra, you wouldn't buy it for any other reason. It does not have any growth in it. It won't go up or down. It'll stagnate. A lot of fund managers will have Telstra in their, and superannuations will have a company like Telstra in their portfolio because it's why? Because it pays dividends, so the company, the customer will actually receive say quarterly or biannually payments, and they're 80% guaranteed that the share price isn't going to crash. So we'll go over that later. So what makes a share price go up or down? There are several things that contribute to a company's share price going up or down. Let's look at just a few of them here. Market news and updates. The biggest thing that pushes a share price upwards, have I read this already? No, okay, is market shares and upgrades. Let's look at an example of how market updates can affect not just the share price, but the share price of other companies as a result. Let's assume you have shares in Google. They are listed on the NASDAQ, which is the National Association of Securities, Dealers and Automated Quotations. That's an American stock exchange. You can buy American stocks if you want to. Not a good idea to start buying international shares unless you've had a little bit of experience in the Aussie market. You open yourself up to a lot of exposures, which is basically worldwide. Anything that happens in China can affect something in America. Whereas in Australia, we're shielded a little bit. So it's a good idea to start in Australia. Anyway, okay, so the NASDAQ is a stock exchange that has the biggest technology stocks in America, are listed such as Google, Amazon, Apple, Facebook, Netflix, those sort of companies, then it's often referred to as the FANG companies, which is Facebook, Apple, Amazon, Netflix, Google, FANG. If you would like to buy shares in Google, you will be parting with 1,000 American dollars per share. Mind you, if you had bought Google 5 years ago, you would have paid only $290 a share. If you bought 10 years ago, if you bought 10 shares, it would have cost you $2,900 US. Today, those 10 shares would be worth 10,000 American dollars. If you bought shares 10 years ago, you would have paid just $54. If you invested the same amount 10 years ago as you did previously, your $2,900 US would be worth $53,700 US. If you invested just $540 in 10 years ago to buy 10 shares at 54 bucks, your $540 would be worth 10,000 American today. Plus any dividends that they would have paid in those 10 years. Massive, massive number. Anyway, let's say Google forecasted in their share market update earlier that in the year that they expect advertising sales through Google AdWords to make, say, 100 million for the financial year based on existing customers they had on the books and factoring in growth elements as well. Now, news is just broken via the Google CEO that company A, B, and C, who were spending $1,000 per day on Google advertising, have advised Google Marketing that they would like to look at other online advertising streams instead this coming year. This news does two things. It means that Google shares will fall because investors will think to themselves they're not going to be able to deliver on their promise of delivering X amount of sales by advertising now that these three massive companies are leaving. Investors think, where else could these three companies advertise? How about Facebook marketing? How about Twitter or Instagram? Suddenly these three shares skyrocket as investors hope these three large companies bring their advertising money to Facebook or Twitter. What does that do for Facebook? Their revenue in their advertising space skyrockets. As a result, come end of financial year, they report massive uptick on sales, which they hadn't forecasted for. What just happened here? One company's share price fell, but like stocks all went up. The other side of the coin, which is more common, is that investors leave the sector altogether in search of a better deal in a totally different industry. What happens in this scenario is Google shares fall as a result of advertising spend loss. Therefore, investors think my money is better spent in the financial sector or mining or metals or healthcare. And not only does Google shares fall, but all the like shares fall as well. For this reason, diversification is key. If you have all your eggs in the one basket and that basket falls, you lose everything.
Always heard about that. Have all your eggs in one basket.
Yeah. I'll quickly try to run through this because I don't think we're going to get to the end. World events are another thing that can move share prices up and down. Natural disasters, storms, property damages can affect insurance companies such as AMP, QBE, Suncorp. Obviously, they'll have big payouts for unforeseen events, and obviously that eats away at their margins as well. International relationships. So China are our biggest importer of steel from Australia and America. If Donald Trump decides to limit how much the USA deal with China, that will send iron ore miners such as Rio Tinto and BHP plummeting. Currency fluctuations is another big influence on companies such as the share price. Look, I'm not going to go through all of this because we're running out of time now, so I don't want to keep you guys for longer than you need to be. Let's just quickly look at keys to picking a good stock. Okay, so we now know the basics about investing and what can cause a share price to go up or down. We have a few ways to look at evaluating a company and its share price. We've talked about how to analyze charts. Now the burning question is, how do I know what stocks to buy? Before you can answer that question, you must ask yourself three important questions. I think there's four there. That is, why am I doing this? What sort of investor do I want to be? What is my tolerance risk versus reward? And would I prefer a regular income or would I prefer to maximize profits on shares? Once you can answer these three questions honestly, as each person is different, you can then make decisions accordingly as to which stocks to buy, as different stocks and share price patterns are different for different types of investors. Important to note, there is no right or wrong answer. Your answers to these questions will help you assess what types of stocks you should be looking to add to your portfolio. let's answer these questions now so that we can better understand why you're doing this. So, why am I doing this? Is it just for fun? Is it short-term day trading to make a quick buck? Or are you looking at medium to long-term to invest for my long-term future? What sort of investor do you want to be? Do you want to be, like I said, short-term, or do you want to be long-term? What is your tolerance for risk versus reward? Either very low, you get nervous when you see all your money disappearing. Low to medium can handle a little bit of turbulence for a great reward. A medium to high, I'm fine with high risk, high reward, or high, show me the money. Income versus profit. I prefer to invest for my retirement, so income or free money sounds good to me. I'd like the best of both worlds, or I prefer to make the maximum profit on shares, don't care about income. So there's a couple of ways you can look at it. If you decide you want to be an income person and you just want to have regular money coming in and you're not worried about the share price so much, then you can look at dividend investing, which is companies like the Telstras and other companies that pay really good dividends. There's a way that you can actually, I think there's about 6 or 7 shares that you can buy, particular shares, that only pay dividend payments. Obviously the share price goes up and down, but they pay every month. So one will pay in January, one will pay in February, one will pay in March, one will pay in April. So basically every month of the year, you're receiving a dividend of some sort. So basically it shows that you'll be able to receive something every month from one of those companies. That makes sense. So that's a good way of doing it, if that's the way you want to invest. If you're a high risk, high reward, if you want to look at the share price and invest that way, then there'll be different shares that you can look at. You would not buy a Telstra, because Telstra isn't, for the next 5 years, isn't going to go skyrocket. It's going to be flatline, and it's probably not a share that you should look at. Cool. Identifying potential stocks to buy. What do I look for in a stock? Here's a recap of what we talked about. Help you identify stocks that have potential to go up in value. Dividends. Does the stock pay a dividend? What percentage does it pay? How often is it paid? Is it tax-free? If not, how much tax do I have to pay? Earnings per share, we looked at. Price to earnings ratio. Remember that cheap or expensive is relative. It depends on what you're comparing it to. Generally speaking, a price to earnings ratio of less than 15 is good. Just because something is cheap doesn't make it good value. When something is cheap, there is generally a reason for it. Yeah, we went through all of that. Quickly dive. Read the charts, look for buying signals. So we looked at the RSI, we looked at the 50 to 200 day moving average. Read the company's profit and loss statements. Market guidance we looked at. Stick to companies and sectors you're familiar with. For me, I love technology, so I like to invest in technology stocks. I'm probably not going to go too much into the oil and energy sector. Don't know anything about it. And with this as well, when they release market updates, if you don't understand what the update is, it's going to be hard for you to know whether you're supposed to sell or buy. They might use terms and words that you don't know about, and it's going to make it life hard. If you're in the technology space and they've just announced that there's new DDR5 RAM or something like that, you'll know what that is. And you go, great, that's a really good thing. The price is going to go up. So yeah, that's one piece of advice I'd give you. Stick to sectors you know something about, or you like. If you like the banking sector, and again, the banking sector is one of those ones that's not going to skyrocket in price, but they pay nice dividends. So if you want income, look at the financial sector. Yeah, cool. So I'll keep going. Broker sentiments is another way. So you can actually, I use ComSec. I also use NavTrade as well. NavTrade is very good. Its interface is terrible, but it's online where you can log in and actually, their charts are fantastic, and they actually have recommendations from brokers. So leading people that actually spend time on this is their job to actually look at every stock and see how is it performing over the last 3-5 years. They'll give it a buy, hold, or sell rating. So that's a good way to look at it, whereas ComSec don't do that as well. So look at that. Liquidity. Now liquidity is very important. Liquidity just means how many shares are being bought or sold of the company you have chosen to buy. Liquidity is important. Each day on the ASX, there are on average 2 billion shares that get bought and sold every day. That's just here in Australia. It's a massive number. That's not dollars, we're not talking dollars, talking shares are traded, 2 billion every day. If the company you want to buy has a liquidity of less than, let's say, 100 transactions per day, I'd be pretty wary. Unless you're dead set confident it will skyrocket. When liquidity is low, you get big spikes. So if someone makes say a one buy or a sell, it can drop exponentially. If someone makes a buy, it can go up exponential. You're going to see money going up and down. It can be a little bit sort of fluttering for the heart if you're not that way inclined. So whereas a company like ANZ or like a bank or something, they will have literally maybe 5,000 to 10,000 transactions a day. So when someone makes a big sell of say $100,000, it doesn't crash. It goes down 5 cents maybe, relative. So yeah, that's really important as well. Depth chart. So you can look at the depth chart. The depth chart will actually tell you how many buyers there are of this product and this company, and how many sellers there are. Then you can look at it and go, okay, so there's 100 people wanting to buy this company. There's 500 people wanting to sell this company. What does that tell me? It probably tells me that either, but look, like I said, this is just indication, so it doesn't mean that it's 100% accurate. It could be people that are profit taking. There are many reasons why people want to sell a stock or buy stock. So that's something to look at as well. Depth chart, that's all available on your app. If you go through CommSec, you'll get all this stuff that's worth really like. Understanding the risks and involved in investing, how the marketplace works will help you in your investing. With all excitement around the potential earns and lots of money in picking up a good company and watching its value skyrocket comes the very real feeling you will experience with picking a company that had so much going for it. Everyone rated it as a buy, and yet its share price is plummeting, and you're watching your investment, however big or small it was, become even smaller. Welcome to the share market. You've just experienced what it is to be an investor. How you respond when things are looking down will either make you a great investor or a very unlucky person who doesn't want to lose any more money. There will be days, even maybe weeks on end, day after day, when you see your money shrinking. We'll go over a few tips later on as to how you can make the most of these times. You can set entry and exit points. So entry and exit points just means if a stock is selling for $5, you want to buy the stock, but you're not willing to pay $5 for it, but you're willing to pay, say, $4 for it. You can set an entry point of $4 so that when the stock comes down to $4, it will automatically make a buy for you. You can set an exit point. So if you buy the stock at $4 and you want to be able to sell at, say, $6, as soon as that stock hits $6, it will automatically sell for you. So you can do that too. It's all done within the app. Safeguarding yourself against, how long have I got, Ben? 5?
Yeah, I was going to say, check your phone. That's right, you sent me. So you can check.
Okay.
But,
yeah, cool. Sorry guys. Yeah, cool. So, diversify. Buy a few defensive stocks. If you feel like you're going to faint when you see your money go down, buy some defensive stocks, because defensive stocks are good when the market is down. People rush to the defensive stocks. Defensive stocks are things like gold miners, because gold doesn't have a value. It doesn't pay dividends. It doesn't really do anything except for the price of gold goes up when there's uncertainty and fear in the marketplace. When they think that things are going to go bad, they'll quickly flock to gold, and you'll see the gold miners fly up. So it's a good way to safeguard yourself against a market crash. Cool. I'm not going to go into any of that. Let's keep going quickly. Just a couple more things, and then we'll. I'm not going to get a chance to go through all this stuff. All right, just quickly right at the end. Key mistakes most rookie investors make. I made some rookie mistakes when I first started. I learned the hard way not to make those mistakes again. Sometimes the worst thing you can do is listen to others for advice. Got some bad advice from someone I thought knew a lot more than I did, and I paid the price for it. Here are 3 mistakes that rookie investors make. They copy. Don't copy what the market is doing. There are many different reasons out there, and people have a totally different gameplay to you. There are short sellers out there in the marketplace. There was a big movie called The Big Short. Where you saw it? It's where people basically they buy a stock and then they sell it in the intent to rebuy it at a cheaper price. So they force the market to go up by buying, and then they make a massive sell. The price drops, and then they rebuy it again and do it again. So that's something to be handy to look for as well. Okay, knowing when to buy and when to sell. So across the page as well. Investors will buy a stock for a multitude of reasons, but despite what they might tell you, they'll only really sell a stock for one of two reasons. A, they are profit taking and moving to a different sector, or they have a fear of losing money. You buy a stock for many different reasons, but you'll only sell a stock for these two reasons. If you want to sell a stock that you own, there are only 4 reasons that you should do so. You're profit taking, you need money to fix a car or an unexpected bill, it's fine. You've lost faith in the company, in the stock that you bought, and you don't believe that it's capable of producing what you had hoped in the first time, that's fine. You no longer feel the share price is cheap or offers good value. If you are selling because you think the share price is going down and you're losing money, this is the worst type of trade you will ever make. The market is driven by fear. You can overcome the market's fear and benefit financially at others' expenses by not being fearful and selling at for the wrong reasons. Okay, and I think that's probably going to be it. Quickly, over the page, paper trading. Paper trading is a really good way of getting started. If you're unsure about about this investing thing, you want to go through it, but you don't want to put on your hard-earned money yet, paper trading is a great way of doing it. There are apps out there. If you have an Android phone or an iPhone phone, you can actually download apps. You can put in your how much you wanted to invest, how many shares you want to buy in this particular stock, and you can just watch it for a week, for a month, and see what it would have given you had you put your money in. So then you can see, is this stock really worthwhile, or would I have lost money? If it looked like it told you that you would have made, say, $100 or $1,000 or whatever it was over that time, then it might be time to put some real money on it. But it'll also tell you, yeah, this is probably not a good idea to do. Look, it lost $500 in its time. So yeah, so it's a good thing to do. That's pretty much all I've got time for, guys. Any questions?
Yeah, great, great.
Thank you. Any questions? Is there any? Sorry, I didn't get to go through everything, but I printed this for you guys so you can take it home and read through it. If you do have any questions, shoot me an email or catch me after church and we can talk through some things. Anything quickly that we might have?
Well, it's a big topic. There's a lot of factors.
It's so much to go through. This is just the entry level. There's a lot of stuff to sort of get your head around. But
so, may I ask, are you an investor?
I am, yes.
Are you a successful investor?
It's too early to tell.
Are you just started?
Only a couple of years ago. It's pretty early to tell. Still recovering from some bad mistakes, but made some losses and some gains. So it's hard to sort of. But I've changed the way I invest. When I first started, I was out to make a buck where I could, and found that there are people who've been doing this a lot longer than I have, and you can make some really bad mistakes. I changed the way I viewed the market and started to care less about the share price and care more about the company that you're investing in. And if you believe in the company that you're investing in, forget about the share price, don't worry. Because it goes down, it'll come back up. And the best thing you can do in a particular share price, if you really like a company, buy when it's down. My number one rule that I have for myself, don't buy a stock when it's up, because it's coming down. Buy a stock when it's, if there's a stock, I have probably 30 watch lists with 30 companies on each watch list. And when it comes down to a certain amount, I think if it's up on that day, I go, okay, I really want to get into that stock, but I'm not going to buy it when it's up. I'm going to wait till tomorrow or next week when it's down, and that's when you get in. Because then when it's down, the next day it'll shoot back up. It's it's this thing. It goes up and down.
Cyclical.
It's everything's cyclical. So that's that's my golden rule is don't buy stock when it's up. And I learned that the hard way as well. Listen to some bad advice. My first share that I bought was BHP, Billiton. Back in the day, I think I paid $11.80 or something for it at that time. It went down to $10 and I panicked and I sold that. It's now worth $22.50. That was only 18 months ago. That was a bad mistake. When you just have to take the emotion out of out of investing. And you look at the stock and go, gee, I've lost $100 today. You just got to look at it and go, oh, it's down today. That sucks. But tomorrow it'll be back up. That's it. If you look at it that way, you'll feel a lot better about your investing, and you know, you change your investing strategy from being a 6 month, I'm trying to gain $1,000 in 6 months, to I'm looking at 5 to 10 years. I want to set up my family. I want to make sure that whatever kids I have, I'll make a providence for them as well in 10 to 15 years time. You know, if you bought Google 10 years ago at $54, it's worth $1,000 now. That's amazing returns. When the GFC hit and everyone panicked, the share market lost 50% of its value. That was the time to buy. That was not the time to sell. People made squillions of money by buying at that time, not by selling.
What are some of the companies now to buy now? What are they? Some of the good ones.
It depends on your strategy. If you want to be an income investor, or do you want to make money on the share price? Do you want money coming every month, or do you want a bit of both? That's like I said, was in this. You got to answer that question for yourself first before you can look at shares to buy. There are penny stocks out there which cost less than 10 cents to buy per share, but their liquidity is very low. So when you get someone buying, it'll spike, and you can make $1,000 in a day, or you could lose $1,000 in a day. So it's not a good way to start. I would start looking at growth stocks, but have a little bit of balance. So have some stocks that are this sort of thing, and then have some that are this sort of thing. But the message is, don't panic when it falls, because that's how you lose money. You make a bad decision, you make an emotional decision when you see your money going. You're not going to lose all your money, okay? It won't go from $5 to zero. They're not going to go bankrupt. They're saying that Channel 10 now, I think going into receivership now. So
I've been kicked out because my share portfolio was too small in the long term. It dropped down to 1 cent.
Yeah, wow.
So they paid me out.
Well, there you go. But yeah, look, the share market can be really, really advantageous. Highly recommend people get into it. But if you're going to get into it, do it with the right conviction, and do it with, have a stomach of steel, and just go, okay, it's down today.
Something I found a concept that I never invested in but was really interested in.
Yeah.
They sell share packs.
Yep.
Which are like, so they're researched
Share
by
packs
the
are great.
traders.
Yep.
And like if you want to be a dividend investor, or you want to be a growth investor, or something like that, they have 4 chosen stocks that you can invest in together. Like you might say, I've got $1,000.
Yep.
And they'll split that evenly across those 4 stocks, and then you're diversified as well.
Yep.
And then that, if you're a dividend, you've got there 4 stocks that are, sort of
Specifically
guaranteed
for
dividend.
dividend.
And Telstra always features in that list.
Yep.
And then there's others that are sort of growth stocks. So
Yep.
that's, if you're new into the space, that might be something you could look into, because.
And you can actually make changes to the share packs as well. So they give you like I say, a growth share pack, which might have, say, 5 stocks in it. One might have, say, an oil company, one might have a bank, one might have a technology stock, and one might have, say, a healthcare stock. A lot of healthcare is going through the roof at the moment, because the old age population is at its highest level, and it's growing. People are getting older faster, basically, and these aged care facility places are
going broke.
Yep. Well, yeah. So utility is a defensive stock. Yeah, so they're very defensive. So they do a lot of, their share price don't go up too much, but you're safe. They're a safe stock, so they're not going to crash.
Infrastructure is the same.
Yeah.
If you have an infrastructure stock, that's the same sort of thing.
So and someone like an Origin Energy or AGL, they pay good dividends as well. And generally those sort of companies are franked as well, fully franked, so you're not paying tax on any of the dividends you get. But yeah, if you want growth stocks.
And what's interesting, you get, for like someone that's not done investing before, you see, like, you do research and you get such varying opinions on certain stocks.
Correct.
And even asking Trav, for instance, what stock would you recommend to buy?
Yeah.
Someone will have a complete
Totally
opposite opinion to it.
Yeah,
Like,
absolutely.
because when I got out of it because I was just too much of a nervous trader. But you do the research and like you see like varying opinions. So it really comes back to a lot of
Yeah.
I don't know, personal choice.
It's your personal. If you have a personal, that's why I said stick to sectors and companies that you know and you've heard of, because you'll be able to understand their market guidance a little better, and yeah, it will make a little bit more sense. Don't go for companies that someone recommends you. You get a. It's not like a horse. You know, you go. Oh, you get a good. Yeah, it's not like a horse.
It's a horse. It's a horse race.
Yeah. So don't go on someone's. You know, put $10 on this dude. You know, it ran last. It's going to run first. You know, don't do that sort of stuff. The share market is not. It's educational. It's educating. What's the word I'm looking for? It's not luck, basically. And it's not. You can be a gambler in the share market, which is not a good idea. You can just have a stab it in the dark at something, and you're basically then gambling. But if you're educating yourself, a calculated risk, yeah, it's an educated risk by way of looking at its previous history and its further growths and looking at the company for its updates. You're making an educated decision as to where the company is going. Like there's a company at the moment. I don't know whether you've heard of cryptocurrency. Do you know what that is? There's a company that make video cards for the computers called AMD and Nvidia. I procrastinated in the US. There's a company called Nvidia. Their share price is there was at $58 about 3 months ago. It's now 150. Just hit $150 American dollars per share. Because people are going nuts for these cryptocurrency. 150 a share now in Nvidia. 3 months ago you could have bought it at $58. Or AMD was about 12 months ago. It was $2. I procrastinated and ended up buying it at about $6.50. It's now worth $15. So it's, you know, you get some good wins in the US market. I feel like some stocks in the US market go nuts, but
you have to be there all the time, watching and learning and
read. Just you don't have to spend every waking minute on it, but just read the market updates when it comes out, and don't overreact. That's the biggest thing. My number 2 thing that I say is that people always overreact to bad news and they underreact to good news. If a company releases a good announcement, share price might go up a little bit. As soon as they release a bad one, bang, it falls. Don't overreact, and take advantage of people that overreact. That's probably the best thing I can offer.
I had a client which was a professor, a surgeon, and to calm his nerves, because he was always cutting up bodies and doing all sorts of stuff, is he used to go on the stock exchange, you know, buy some shares. So he would buy shares. He'd have a portfolio of $500,000. He would sell and buy, and 1 year he'd lose 50 grand. Next year he'd gain 100 grand. Right. That's how he used to play, and he used to de-stress it.
Yeah.
That's what he did.
Yeah.
De-stress.
But yeah,
Only
one
a
last
surgeon.
thing that I'd leave you with is don't wait till you've got $10,000 or $100,000 to invest. It's never going to happen. You won't ever have that much money free to do it. Start with $500, the minimum. That's what I did. I started with the minimum. And then I try to, once a month, I try to add to that. And if it's a particular stock that I like, I add to it when it goes down. If you go with ANZ have one called E-Trade. There's pros and cons for both. I like the ComSec one, but the E-Trade one is great because their minimum is 600 instead of 500, but they will allow you to buy one stock, one share, or 10 shares of. Once you've bought 600 at the start, you can then add to it, just buy another 10, buy another 15, or buy another 20. Whereas ComSec, it has to be 500 per buy. Every 500, if you want to add to your portfolio, you have to add another 500 minimum. But if you're getting started, ComSec is great because they have. I think the deal is still going. They have, when I first started, I've seen it for a while now. Your first 10 trades are free. So they don't charge you the $19.95 or the $10, whatever it is now, per trade for your first 10 trades, just to get you started. If you go to the ComSec website, they have an update a morning update, which I watch morning and evening, just tells you what's happening during the day, what happened last night in the American markets, what happened in the Asian markets, because the Asian markets, the UK market, when the Brexit happened, the pound just plummeted. And people bought the pound, and now the pound has gone back up. And that's how people, it's called Forex, which is foreign currency exchange. It's a way of trading on the currencies. You can do that too. Or another way you can do is you can actually buy what they call an ETF, which is an exchange traded fund. And that if you don't want to get through, start in the American markets, but you want access to all the, say, the greatest companies out there, there's an ETF which is the Nasdaq's ETF. So basically, it's one share that you buy, and that company owns all of those companies. So you're getting access to all of those companies within just one share. So you can actually just buy that exchange traded fund. And so they have a fund of Apple, they have Facebook, they have Google, they have Amazon, they've bought shares in this company, and then they allow you to actually purchase a share in that. So it's called an ETF, exchange traded fund. It's a good way of getting access to that without actually having to go out and spend $150 on an Apple stock or $1,000 on a Google stock. You can get access. So when their share prices are all up, then the ETF is up. When they're down, then the ETF is down. So like an ETF might be only, I think the Nasdaq ETF is $12 or $13 or something like that. It gives you access to all of those stocks.
They tend to average it out.
Yeah.
Unfortunately, because you don't get the highs and lows.
Yeah.
Average it
You
out.
get the flat average.
Have you ever invested in like a fund, like
Yeah.
like where that basically they invest and they sort of semi-guarantee a percentage return per month or something like that?
Yeah,
That's
yeah.
something people could do too.
Yeah, you can do that as well. Yeah. There's fund managers out there where you can actually join. You pay a subscription. There's one that I'm with at the moment called Fat Profits. They're very good. You can ring them up and go, listen, I'm looking at this particular share. What do you reckon? You get your own account manager basically, and they look after you. What do you reckon? Can you get your team to look into this stock and tell me what you think? You can get some free advice that way. Not free, I mean you're paying a subscription, but it's a good way. They release a weekly update on the resources. So the resource section, which is the materials and the gold miners, and they give you companies that you should buy or look at buying. They'll tell you when to sell a particular stock, and you look at their history of what they've achieved. You can look at their portfolio and what stocks that they have in their portfolio, and you can see what they bought for and what they sold for, and you can see that they've made a lot of money on their particular stock. So you could do things like that as well if you wanted advice that's not a mate or whatever. You can speak to experts and they'll tell you what they think. So it's a really good idea. But yeah.
Cool.
Cool,
Sorry to keep you guys here.
Well done.
Asking we should, but really appreciate you guys coming out and hope you got something from it. Like I was telling Maddie and Brendan before, if no one got anything out of this, I certainly did by doing this myself. There's stuff that you think about, you don't think about, but when you go back to the basics, you go, yeah, actually that's really true. I really don't use this as much as I should, and I got something out of this, so thank you for the opportunity.
Thank you very much.
Yeah.